Hey everyone, welcome back to the Nodland Forum Podcast Daily. This is Lior here, and today, well, if you caught the headlines, it's all about that giant move from the Fed. I'm talking $125 billion injected into the US banking system. Yeah, you heard me right. 125B, as in billion. And honestly, that's the kind of number that can make anyone spill their coffee. So, let's peel back the curtain a bit on what actually happened. The mechanics are mainly these repo operations. Now, repo, I always have to pause and remind myself, it's short for repurchase agreement, which is less exciting than it sounds, but super important. Basically, banks give the Fed stuff like treasuries, the Fed gives banks cash, and then a day or so later, they reverse it. It's a way for banks to get overnight cash, especially when things are tense. And they're tense right now. Bank reserves hit 2.8 trillion, which is the lowest in 4 years? That's a big deal, because if reserves get too low, that's when, as a banker, you start sweating. Trust me. See, most of this is fallout from the Fed's whole quantitative tightening parade. They've been trimming down their balance sheet, rolling off treasuries, letting mortgage-backed securities run off too, all to pull back extra liquidity to fight inflation. But you get to this sort of ample but not excessive point, where if you go too tight, you risk a breakdown in what I like to call the economic plumbing, right? So you get rising repo rates, signals start flashing, and the Fed says, okay, time to step in. And I gotta tell you, it gives me flashbacks to 2019 when overnight repo rates just spiked out of nowhere. I remember investors freaking out, people seriously calling me at all hours thinking the whole system was gonna freeze up. But this time, the Fed acted ahead of panic mode. And if I'm not mistaken, the single biggest one-day repo since 2020 happened on October 31st, Halloween and everything. Perfectly spooky timing. So, anyway, now we see the Fed hitting pause on shrinking the balance sheet, aiming for a smooth landing. At least that's what they're signaling. It's not about stimulus, not in the classic sense. It's more like, let's make sure nothing breaks. The official end to the tightening cycle, supposedly, is December 1st. We'll see if that actually sticks, but for now, the system is getting some much needed breathing room. All right, now let's connect the dots to real estate and lending, which, let's face it, is why most of us tune in. So, what does all this liquidity mean for lenders, especially those willing to color outside the traditional mortgage lines? Think DSCR loans, bank statement loans, stuff that helps folks like self-employed entrepreneurs, freelancers, or real estate investors who don't exactly fit the W-2 cookie cutter profile. Mark Halpern from Foundation Mortgage actually called this a quiet win for lenders who serve those segments. He's right. And honestly, it's a rare moment of good news if you're in the non-QM space. More liquidity doesn't mean rates will drop tomorrow, but it does mean lenders are less likely to slam the brakes on these more flexible mortgage options. Far as I understand, it's giving credit channels a chance to breathe when, not so long ago, we all worried about the credit box shrinking again. Let me give you a real example. Just last week, I sat in on a deal where a client, an entrepreneur with digital businesses, needed a bank statement loan. Traditional lenders kept turning him down because his tax returns didn't fit neatly. Big surprise there, right? But one lender, bolstered by confidence thanks to this new wave of liquidity, actually signed off on the deal. That deal isn't some outlier, that's the real-world impact of liquidity on lending. If the Fed hadn't stepped in, my client might still be hunting, or worse, priced out. It's these stories that show you it's not just a bunch of numbers on some central bank spreadsheet. This is how policy decisions ripple right down to families and small business owners trying to make their move. Which brings us to the big question. Where do we go from here? The Fed's in this awkward dance. They need to stabilize things. Make sure banks aren't clutching their pearls at the year end, but they don't want to go too far and ignite inflation again. It's control, not panic. That's what they keep saying. And I think that's spot on. Economists have made it clear. This isn't an emergency, it's just prevention mode. So, let's talk forecasts. We've got year-end pressures ahead. Always a tricky period. Liquidity tends to dry up. Everyone wants cash on hand. The market seems pretty convinced there's another 25-point rate cut coming in December. And honestly, based on the CME probabilities, 67%? That's not just a hunch. It's almost consensus at this point. But here's the thing. If funding pressures ramp up again or repo rates go haywire, the Fed may have to step in with more targeted liquidity. Nothing's guaranteed. So, if you're a real estate pro listening to this, should you brace for more curveballs from the Fed? Or is this it? Are the hardest months behind us? I wish I had a crystal ball, but if we're judging by tone and timing, this feels like the Fed taking a breath and hoping the system steadies on its own. But as we've seen in past cycles, and we talked about this in the episode on volatility and mortgage rate surges, sometimes the market throws a twist no one sees coming. The key is being ready for anything, staying sharp on policy updates, and making sure your financing partners are nimble. All right, that's it for today's episode. We'll keep tracking these moves as they come and break down exactly what they mean for your deals, your clients, and your strategies. Thanks for tuning in. And remember, when the Fed blinks, it's time to pay attention. Catch you all next time on Nadlon Forum Podcast Daily.